Good evening, everybody. This is Ken at Tortoise Capital. This is the strategy report for Sunday night, getting ready for tomorrow. Looks like tomorrow is going to be a disaster at the opening. The Dow futures down 4%, 4.5% in the S&P, Nasdaq down over 4%, oil plunging 20%. Yep, things are disastrous right now. These were the comments that I was making with my doctoral students who are trying to figure out how to become, strategists and whatnot, and I was trying to help them understand the relationship between terminal degree holders, doctoral analysts, and CEOs who live in the world, and we just kind of went through, the volatility that's in the headlines, and then some of the challenges about things that actually move the markets. Here's a really nice discussion from Zero Hedge that talks about the effect of Corona on the world and some long-term challenges. And then I went through a set of 7 different analysts and how they were recommended people respond, and arranged all the way on one hand to batten down the hatches and prepare for worldwide disaster, and other ones that were just taking a much longer term view of the world and looking at us as buying opportunities, and then all points in between, some of that were based on psychology, some on technical analysis, some on fundamental analysis, some on based just on kind of insurance and uncertainty. And the point being that, at least with my doctoral students, what I was trying to help them understand was that everybody that has an opinion and comes from a certain perspective and has evidence that is offered to support that conclusion, but that what is expected of terminal degree holders is that there is some kind of ecosystem kind of approach. It shows all the different ways that situation may be framed, and then some guidance on how to think about the overall solution and opportunities based on multiple perspectives, not taking an advocacy position, but really laying out the options. And that's hopefully what I'm trying to do for you guys, is show you all the different ways in which the market can be addressed, and it may be exploited or approached in a humble way. So I took them through some of that, and then we just looked at the magnitude of the moves. Just as a quick reminder, we're at about 13% sell off. Well, if another 3 or 4% sells off, then we're going to be down around 17 or 18. That would bring the Dow down around 280, or the S&P down around 2,800. On a weekly basis, those 2 big sell-offs, and then closed very weakly, and then another 3 or 4% sell-off at the open. And you can see that thing's going to be pushing Z2 on weeklies. On a monthly basis, there over the last 10 years, we just hit the PSAR flip, and the last time there was a PSAR flip was here. You can see that penetrated all the way to Z1 on a monthly, or Z minus 1 on a monthly, I should say, which would take it down around 260. And then the recovery kind of happened. So 260 in the short term this month is still well within reach. And then that puts at risk the last 2 years, really. And then fair value is not even down here till about 240, 235 on a monthly. And that puts into account, here's the Trump bump is really from 200 and above. And so the normal course of events would have pulled this thing up to 235, and it got as high as 350. So you can look at this, in my view, as the Fed pump, and then the shift to the shock to the market, that is the Trump reorientation of global markets to the U.S. as a predominant economic force, and being an aggressive trading partner for short-term squeeze. That's all being put at risk now by the virus, and then the slowdown in the broad markets due to the just the added tax that's going to be on global supply chains as a function of um, concern about spreading the virus. You just look at it like I look at it like the Transportation Security Agency and the net effect it's had on U.S. air flights, and you add that to that price to global markets, and then I think a reorientation is people are going to realize over the next 5 to 10 years they're going to have to bring their manufacturing home so that they're not vulnerable to what used to be the low cost world manufacturer. So that looks to me like an implosion of China's economy for the next 10 to 20 years. So that's a global repositioning that's going to happen regardless of who's in power, and that's going to be just a function of risk management at national levels as people try to rebuild their productive capabilities. So I see that being kind of a dominant theme for the next 10 years. So depending on the time frame you have, this looks to me like a tipping point in any long-term approach to the market. So that was some of the challenges for strategic planning and organizational alignment that I was given to my doctoral students, because they're tasked with the job of helping organizations come to grips with the new ecosystem and trying to come up with new strategic plans that will allow them to survive contact in this dramatically changed world. So there's that. Meanwhile, tactically, what are some things that we got to be able to do? We're going to remember that VUCA, that's these elements, VUCA is central to what we're talking about here, and that is the idea that volatility, uncertainty, complexity, and ambiguity are affecting the complexity, and not the complexity, but the challenges of the world. Because you can't. A lot of people will use those four words as if they are identical, but they're not. So where did that go? So when we're thinking about in a technical sense, all four of these words mean very different things, and I just want to hit that. So volatility has to do with the magnitude of change, the rate of change, the pace of change, and the frequency of change. All four of those go into challenges into the state of nature and the decision making. Right, so that just has to do strictly with the rate of change, whatever that change is or whatever the cause is. It has to do with those shock waves generated by each change impulse. So uncertainty has to do with the quality of our knowledge with respect to the total available knowledge. How much of it do we think we know? How much do we actually know? If it's less than 40%, we're really trying to guess what the shape of the future and the current state is on the basis of a very incomplete view of the mosaic. Somewhere around 70%, the broad outline should be available to you to make significant decisions, and then the last 30%, filling in the gap. So that 0, 40, 70, 100%, sets up three regions where different kinds of strategies are appropriate. Complexity has to do with the mathematical computation of possible future states based on the number of variables and the number of positions that could be had in each variable. So if there was 10 variables and each variable had 10 different states, you could look at that as the power of 10 to the 10th possible states of nature. And so at some point, complexity becomes non-computable, and you get something like chaos where everything is each individual variable is subject to laws of nature and computation. But when you start looking at the combinations and then the sensitivity of the overall system to the starting point, you get something like turbulence, which is a chaotic state in which everything is everything behind an engine on an airplane or a ship is being governed by the laws of physics, but there's so many variables and so many interplays and so much complexity from those variables that you can't make great predictions at the level of fidelity that you might want. So there, you can get broad estimates, but you can't get to the precision. And in some cases, the final states of where things could end up are so diverse that it's in many ways indistinguishable from random. And then finally, ambiguity deals with the fact that you could have two mutually exclusive explanations supported by one piece of evidence, where that single piece of evidence, and let's say that you were certain about it and it wasn't changing, but that piece of evidence is could be counted as evidence legitimately by more than one mutually exclusive solution. So this is a case where the very ambiguity of what we actually know doesn't help us reduce the future to a predictable one. So when you start adding all four of these things, there's probably a multiplicative event or effect of those. And so VUCA is how we think in the military and in the strategy world about the nature of the environment that we're operating in. And then that drives the kinds of plans that you think you need, and then the time frame in which those plans are effective. And so I want you to just bear that acronym in mind. VUCA should be at the center of your thinking at all times about what to do about the future, today, tomorrow, next year, and so forth. So I'm going to take a look in the chat room at a question Kim D asked me about what to do in these kinds of uncertain times. And what you've heard me say this whole week is that I am reducing my exposure to swing trades and doing a lot more on the intraday, where at least the liquid market gives me some sense of direction. The predictability of the directions of the markets when it's sideways volatile is nil. There is exactly as many large range days in either direction that come out of sideways volatile markets, that overall the net result is flat, but that the size of the intraday moves are enormous. But there's no carryover value from the size and direction of those moves to the next day. So that defeats the swing trade concept completely, in which you have a belief that one of the directional moves has a higher probability of follow through than the other, that there's some impulse that causes a larger than normal move in a specific direction, supported by reasons and then followed on and reinforced by momentum. When you have sideways volatile markets like we do now, what you have is more of a coin flip about the directionality of the next day, and so there's no edge in holding swing trades by and large. That the larger the index, the more broad the index, the more likely that a coin flip for a large move the next day is likely. And I think that's what we're seeing now. Although, if anything, you can see this thing tipping over into a directional move to the downside in short term. So if anything, that's kind of what we're doing now. My preference is to trade that adverse volatility intraday whenever possible. I have a couple short positions paid for by intraday gains in certain targets, which we'll see here in a minute, but certain target symbols. But I'm definitely reduced my short-term or my swing exposure, I should say. Let me shift to that discussion for those of you, for the subscribers, so you can see what we're talking about in the chat room. So there were just some things I wanted to cover from the chat room. So this was kind of from Friday, and I just thought there was some really good discussion. So Friday, Steve posted a really nice trade these are on, I think this is a 15-minute chart. Yeah, oh yeah, that's right. Yeah. And I talked a little bit about it on the Friday chart, but you can see how he's pinpointed the crossover where everything crosses back over the 90, it looks like, and then there's a collapsing drag in here. And then when the belly of this one collapses, there's a second leg down, and that corresponds to a tipping point here in the MACD histogram. So really nice trade frame. And I put this out in Patreon so you could kind of see it. And I suggested that you read that with a view towards feeling what it was like to be Steve when everything lined up and this preparation met opportunity and it unfolded with confidence in the way he traded. Steve also asked me, hey, what were those big black boxes for? And that was really the start and the end. So this was kind of what he was asking me. He understood what the red and green dots were, and then when I'm using yellow areas, what am I doing? These big black boxes are what he was talking about, and those are simply the start and the end of particular moves. And I'm bracketing that trades, and then I draw it down to the MACD histogram in the 4 seasons, so I can see where in the move I'm making my entries and exits to see if I'm aligned with my seasonality. I talked a little bit about the a change I'm going to make in the educational programs for the workshops. I've got so much material that I've just kind of chunked into Basecamp and laid out there that I don't feel that I've offered a systematic way to very efficiently go through that. So I'm going to go through a major engineering project to put that into almost like a library of home study courses that you can buy an annual library pass to, but also at my elder daughter's, who is my strategic planner, she said, Dad, sometimes people just want to find what they need. And so she convinced me that an a la carte system where I get some reasonable low-cost price for just the individual, like workshops or lessons, might be all that's needed. So I'm going to end up doing both of those. This was that gold trade from Eric, just beautifully marked up, and I put it in Patreon as well. I added some coaching. So when you put stuff in the chat room, we read that carefully, and then we talk about. I looked at 3 different these yellow boxes. I talked about this on Friday about feel the difference in price action in each of those boxes and how it should make you feel as a way to start developing that ecosystem approach. So this is the one I wanted to talk to. Kim was describing what it's like acquiring proficiency in the systems. And so he's a retiree and has started to adopt these different strategies, and he's been doing a systematic approach towards studying, then paper trading with accountability, and then small scale sizes to get on board. And these are, I thought, very useful comments. So he's been undergoing a deliberate process that began with the workshop and then with boot camps, and has really been doing the work. And so he's talking about leveling up and going a little deeper. And he highlighted these comments that I've been making this week. These are not normal times, and as Ken said, the normal patterns and rules may not apply. The global effect of the virus, and with no cure in sight, leaves us in a chaotic environment. He has a belief that fear and uncertainty will move the market down, as well as some other negative factors. So his question to me was this one: if I believe the market would continue to move down in the short term and I had investment funds to place, how would I apply those funds to capture a significant downward move? I said, and he reports correctly, to avoid the longer term trades for now. So understanding that this is a unique opportunity, he's willing to be aggressive with all of these funds. I understand that this is a short-term strategy, may not be suitable, and I'm retired and have time to day trade. He's said, yeah, it's timely that the options and futures chat rooms opened up, as those are the vehicles he's considering. He's already started implementing in UVXY, SDOW, and VIX the volatility and the triple leverage Dow. And so he was looking for any thoughts and opinions. So I have some things to say about that. I will come to that in a second. Eric talked about this. This was an additional response that he made concerning the feedback and the coaching that I had applied to his gold trade. And I really strongly recommend you read the way he talked about how he answered his own questions. And this is how you know that he has internalized this stuff and is taking action with his own self-coaching, that he applied some systematic thinking about his situation in the same way that I would do. And so now I know that he has internalized these things. So he's been working these trade. So these trade conditions came out of the work that he had been doing in the coaching program with the strengths, weaknesses, opportunities, and threats. And I'm going to show you something awesome that the Euro team has put together. So he asked the question, not of me, but really as of himself. How do I make myself available to market decisions in the most efficient way? So like some of the other Euros, he was in a certain condition about how many hours a day he could trade and so forth. So he goes through some analysis and then he comes up so those are the questions that he had asked of himself. And then importantly, he said these were the answers. So how could he use the time that he had available and the size of the moves that could work? And then how does he adopt some rules that are well suited to his personal conditions? And then he put together some important rules. I felt like, number one, the idea that the money is already lost, in order not to have fear about the trade, but to just say, I've already experienced the size of the worst loss that I'm going to tolerate. And so that doesn't shape the decisions carrying forward. So you remove that anxiety once you fully experience the 1 hour loss that you have budgeted for. And then everything that is better than the 1 hour loss actually can be seen as a gain. And then number two, he says, number two, if I didn't happen to move the stop to no lose plus dinner for two around a gain of one, or so he's got to have some way to answer that, to put that into place about how to be in a locked in positive move if it gets to 1 hour in hand, and then how to trail that trade if it gets beyond 2 execution hour by preserving at least a third, or at least 2/3 of the gains. I think those are pretty sensible. So he's put that out there for us to work on. Kim followed up with some additional questions and follow-throughs. And so he asked me, has my daily trading plan been affected by these market conditions? He also asked me, hey, what did we not do one Saturday? I'm not going to do the nightly strategy sessions on Saturday. And the reason is I did one on Friday. I'm doing one tonight. And so it's not going to change on Saturday. The best thing to do is listen to the closeout on Friday, come up with your own trading plan on Saturdays, and then maybe listen to the Sunday evening one as a sort of a check on oil. Kim asked me also, are there any financial analysts that I follow? Who would I recommend? And so this was my answer to all of those things. So no, I didn't do a strategy session Saturday night. I just forgot to cancel that session. I went ahead and canceled all the future Saturday ones. I can't sustain that level, and I don't think they're needed. So I'll be doing Friday nights and Sunday nights. The people I listen to, literally, I listen to Buffett, Ray Dalio, and Farnham Street for live wisdom about the markets and critical thinking, and that's about all. I like reading Zero Hedge for the humor. They have kind of a dark Russian style humor, and that's their background. And it just reminds me about all the leverage guys that are out there beating themselves up. Market Watch and Yahoo Finance to see what the herd believes and what they're going to respond to. And then honestly, the economic forecast and discussion I listen to are the doggone charts. I look at my charts to see what I believe by using the multi-time frame, multi-lens analysis. That's all. I turn off all the other news in terms of shaping my opinions about what might have. I don't need to know anything from anybody's interpretation because I just look at the stats. I look at what the size and the magnitude of the moves are. I map out the support and resistance levels. I look at the Bollinger Bands, the slopes of the regression lines. I trust my indicators, which are math-based, statistics-based. bulletproof. And then I use that lens to guide what I think about is possible in the market, and I don't make predictions about direction. My advice to Kim is I would be measured and careful about leaping into the volatility aggressively with his retirement funds. But then that's exactly the same advice I give all the time, regardless of volatility. So there's that. And he's a grown man, and he knows his own risk tolerance, skill level, and objectives best. And I trust him to make his decision about what to do. Now, he asked me what I'm doing. Here's what I'm doing. My general strategy is to shorten the time horizon and roll all of my swing trading capital into the short-term capital. So instead of 20-40-40 split between long-term position trading, swing trading, and day trading, right now I'm at 20-10 and 70. And the only and the day trades are where the only day trades I'm taking are ones where I'm managing the position with my finger on the trigger live. And the only swing trades I have are the ones where I have funded that overnight risk position with intraday trades that where I had made money in hand and kept a piece when I was exiting the day trade. So that's all I'm doing on swing trading. So I've gone from like 40% of the capital on swing trading to about 10%. So that's what I want to say about that. Let me shift to the weekend reports real quick, and then I'm going to come back. If you're still hanging around, I'll take a look at some things that came out of coaching. It's pretty cool. Bearish, volatile, and massively oversold on the 3-day look back, at the low end of neutral on all the look backs except the annual. So we're right on the boundary of those things being massively oversold. Look at ETF2 and BMR protecting us from the start of the year start of the month in treasuries, cash, and a little bit of gold. I mean, it's a dumb system, but doggone, sometimes that's all you want. The volatility of risk Z is at almost 4 sigma adverse. ETF2 is at 0% exposed. Monthly, I've talked about. Weekly, and then the daily. Excuse me while I wonder why that thing has been. It's out of memory, so I have too many things open. And I talked a little bit about this stuff on the speed run on Friday. So all you got to know is it's the market and volatility right now. Okay, so I'm going to shift right over to the Patreon stuff. All right. So these were the comments from Zero Hedge that explained, in their view, some of the massive buying that occurred at the end of the day in the last hour. They think somebody got blown out that was way over leveraged. And so it was a funny story. And then some of the commentaries are just tasty. They're just funny. There was some questions somebody asked me about alpha and beta and portfolio heat I wanted to share. So I think this was, SV asked me about this one. What are my thoughts on correlations between swing positions? In day trading, you can go short, but on certain days like today where there's a drop, won't all the overnight equity positions be subject to greater risk? This is a central idea and is kind of pushing me in the direction of getting some of these into a focused course on market beliefs that are outside of the ideas of specific systems and really more on the educational side. So there's alpha, beta, and portfolio heat. Beta is the market correlation of each position. So conceptually, each swing position is cross-correlated through beta elements. So to the degree that they all are moved a certain amount by the market, then when the market moves, their beta moves them in that market direction a certain amount. And then differential occurs based on their alpha, which is that part of their movement that is different from the market. So you got to know, this is called the covariance of true diversification, is how much do their alphas diverge. But, and this is the point I want to make. The real trick here, let me zoom this up so you can really see it. This is so important. The real trick is that correlations change based on what is happening in the market. So when the market is going up or grinding up or a runaway bull up, the correlations between like indexes and market sectors and companies in the market is going to diverge, because market or the money is trying to find the single guy that's winning the most and really pile on him. And so as as money cycles around, the correlations between positions diverge. But when the market starts to crater, all of those historical uncorrelations begin to converge. And so things that used to be diversified when the market was in its normal bullish grinding mode, all of those correlations, those diversifications disappear, and correlations move towards 1.0, meaning they all go down together. So I take the position that what is actually most important for risk management is this idea of portfolio heat. And so you just assume that on your worst day, everything hits your stop and you takes the maximum one punch hit. And that's sort of like that experience of experiencing the loss of 1R when you entered the position, so that you know what that feels like. You don't count that money as yours. It's already gone. And so at the caveman level, which is where I like to operate, I try to spend more time with this experience about, man, I've already lost all that money. Can I still survive? And then that helps with the survival decision making in times of massive panic. So it's not like I haven't engineered my position so large that I can get the maximum reasonable exposure according to diversified correlations. No, I leave a lot of money on the table when I'm in those kind of conditions. I live for the day when things are happening like right now. And this helped me survive in the internet sell-offs in 2003. It helped me in the market meltdowns of 2008 and 9, helped me in 2018 and 19 in the fourth quarter sell-offs and the Trump sell-off. It's helping me now, so that the greater the panic, actually, the more I feel like, it finally happened the way I've been dreading the whole time. And so this is actually when I do my best, at the caveman level. So the way I do it is really, you just need an instrument that you can be practically market neutral in your portfolio heat in a single shot. So that is whatever your long-term positions are, or your swing trade positions. How much do you have to be able to put into one of these very leveraged and volatile instruments like TVIX or UVXY for volatility, or the triple leveraged Dows or spiders, to get all of those to market neutral? So, like as an example, I bought and held a swing position in UDow from Friday. So I bought them around 83. It went up as high as 92. I cashed everything for the intraday, but kept a swing position because I thought, there might be a chance that it goes up. People think that's the plunge protection team, and maybe there's a big gap up. Well, it turns out there's not going to be one. So all I had to do on that one, because I wanted to maintain that as a swing position, is bought the equivalent position in SDOW, so that I was market neutral over the weekend. So the market's going to have, if it holds up the futures like right now, I'll just have a market neutral position when it opens, because the amount that UDow goes down will be reflected in SDow going up, and so I'll be market neutral. And then whichever way it decides to go, I'll just take off one of those positions, and then get directional with the turbo trade, and then that way I can actually keep the UDow swing position. All I got to do is make sure that I am leveraged. If the market's going down, I just keep the hedge on, so that one remains neutral, and then just trade with turbo for the directional move of the day. And that way I can kind of balance that swing versus the the intraday trade. So I would just say if you're a caveman and you do have long positions like position trading and swing trading and you don't want to get out of those, yeah, you can do that with options and futures. I get that. That's what they're supposed to do. I am more of a in my accounts a leveraged ETF guy because that's what I can trade in some of those. I still trade futures in a separate account, but I try to keep each little account pure inside itself because in some cases I'm trading for family members and I have to protect their accounts. So I would just say know what your number is at all times, and that's your portfolio heat. So that's what I wanted to say about that. I wanted to hit this highlight. Uh, this was really nice. This was from Alex. So Alex, oops, sorry, where are we at? Hmm. Oh, Steve asked me. I remember what this was. Yeah, Prime Minister question times. This was funny. Uh, Alex asked me, assuming that my trading universe was limited to futures contracts, which three would I use in order to rank the different, or which methods would I use to rank the different markets and to identify which contracts were likely to make the biggest moves? Uh, so how would I do that? I said, well, I actually answered this in two ways. The first one, I said, which futures contracts would I specialize in? Because more often than not, they are not only very volatile in both directions, but they are least correlated and they're very, very liquid. So even if you didn't have any other reason to trade them, the fact that they're very liquid and directional and least correlated is pretty good. And then I'll talk about my strategies of how to pick other ones. So the ones that I would pick, oil for oil, and energy because that drives the world market. And then either the S&P or the Dow in order to get broad exposure to very liquid U.S. indices tied to all the broad sector segments. You know, I like those rather than the Nasdaq and the NQ because that can be a little overly focused on tech, right? And then if I was going to add a financial instrument, I would play the Aussie US dollar pair or the Treasuries futures in order to get max diversification among those three elements. I would add as a second tier, as a close second, Mexico, Brazil, and the volatility like VXX or UVXY, because they are all frog champions or enormously directional intraday. Now, the three methods that I would use, I'm going to come down here and say, in other words, I'm answering his question by doing exactly what I do for all my trades every day. So what he asked me to do at the brute force level was really, what do I always do? And I don't do anything different in times of max volatility as I do at any other time. So the things that I do, and this is from the base camp or the boot camp workshops too. I use the multi-time frame, multi-lens analysis. I use that process to locate each of my targets, starting with the broad market in their 1, 3, 10, and 30-day look back periods, and then look at the shape of the volatility, expanding or contracting, and establishing a price ladder using support and resistance and the Bollinger Band means and the RLCOs, the moving regression lines, in order to mark off those key price levels. And then the intraday trade, I start off with the hybrid frog and then leads into chain trading. And then I scale that up and outward. And what I mean by that is if I'm going on 1 minute charts or 3 minute or 5 minute or 10 minute or something like that, scaling outwards, I mean expanding the time horizon and going to 30 minute, 1 hour, 2 hour, daily, weekly charts, scaling outward in time. And then building swing positions on the basis of having success with markets money in the shorter time frames. So I'm owning those swing positions in many ways with money that's being made from the intraday trades. The second method, I'm looking to apply continuation patterns by using hourly RLCO MACD frameworks, emphasizing emerging dragons, collapsing dragons, the Z3 pinches, and applying the various strategies from the 37 strategies report, or that document, and from the daily report, or as shown by the TC 2000 bundle. So Danny has done an amazing job of mapping all of those strategies into the TC 2000 bundle, which expands your insights not just to the Dow 30 and the ETF 30 that I use, but also looking at any of their components of the S&P 500, or building your own symbols of interest, and then being able to apply all of these different strategies and systems to your targets of choice without even being tied to my daily report. That to me is information freedom in the future for you. I'm trying to work myself out of a job here, but really it's the way that you can achieve independence of insight through the leverage of the lenses that we're working with here, so that you're not, God forbid something happens to me, wondering where the next report comes from. That TC 2000 bundle is the way you get cognitive independence from the analysis and the framing of trades. I'm doing my best to help you see the market the way I'm looking at it and keeping it robust, but TC 2000, in my view, is genuine diversification of insight that comes from a systematic view of the market. And so +1 to Danny for helping me put myself out of business here. And then the third thing is I would scan for any of the formal swing patterns and then frame the mechanical trades in the way those systems suggest. And then I would frame all of the trade, and I'm going to just beat the drum on this one. I would frame all the trades using the trade frame questions that I teach, and trade them all in the same way with the same techniques, using the execution as I noted up here in number 1 about the hybrid frog and the chain trading and scaling outwards. In other words, I'm answering the question by saying I would do exactly what I do for all my trades, but using them for the restricted set of ETFs or futures that AR has available to them. And so in a nutshell, what I've just said in the last 10 minutes is the basic workshop approach in a paragraph. There's no mystery, there's no secret sauce, there's just a lot of hard work and systems thinking, and then the confidence that comes from doing the work and getting repetitions in this craft knowledge. So Steve asked me, when I say Mexico, Brazil, and volatility is a close second, he said, do you mean Mexico, Brazil, and stock future indexes and VIX for volatility? Yeah, and that those correlate to my favorite ETFs for trading as as a frog champions. That's EWW for Mexico and EWZ for Brazil. And the reason those are so amazing. Here's Mexico, and let's just look at the swings on daily charts, how those things swing beautifully. And then on weekly charts, those are big. Look how orderly that dragon flows in those peaks and valleys. So like when you see something like, if I can draw this, let me draw this trend line. Yeah, so when you see this, that kind of a trend line, now all of a sudden these little gizmos in the middle, like that pocket, and then the collapsing dragon gives you that move. And then you see that when it rebounds and it rolls over again. Look at this move. You get a RLXD and a collapsing dragon from 48 to 38. That's a 20% move in 3 or 4 or 5 weeks. And then this one, the dragon rolls over and you get this move. So then when we zoom in, you see that how that dragon rolled over here, and now you get that move. And then the moves on the intraday are even more massive. So when you look at EWW, and now if you just looked at the monthly, you could make a living on the RLXD short here. You got short here, and then just use the PSAR. It called that 57, so you get short at 50 with a $6 or $7 stop. That's a 10% stop, and you're in that thing all the way down to 40. And you could have cashed it at 35 twice without any stress. And then if we go back even further, that move on this collapse. Look at this collapsing dragon from 64, and the reason why you're interested in that one is the dragon made a lower high. Let me draw that trend line a little better so you can see it. Look at that one. When you have a hump and a lower hump, and you see it triggered initially by the RL10 rolling over, and then the dragon rolls over, and now the RLXD inside here, you're short this thing at 64, and you're in it all the way down to 40, for crying out loud. So longer term, those Mexico, Brazil, the Dow, and just knowing your RLXD framework and the 4 seasons, that's the key to sanity on the position trading, my friends. And then if you look at this on a monthly, look at this one in here, getting short at 50, and then using the PSAR all the way down, and now you're short that thing at 38, and you always had that position. And you can adjust that one weekly if you want, but the base position off a monthly and even weekly charts is amazing. And Brazil does the same thing. Look how orderly that thing fails on the monthly, and then on the weekly. Look, oh God, just makes me sad that more people aren't doing this. So there we are. Hey, that's everything I wanted to cover for tonight, I think. Actually, there's one more, if I may. And I just want to show you what I think is some amazing work by the guys in the Eurozone, right? This is just so good. So good. So if you take nothing else away from my strategic approach to the market, try this. This is that SWOT analysis, the modified SWOT analysis. I've adapted this to my own use and to my consulting outside of finance as well. And it's really good. And I'm writing an academic paper on it. It's just gold. Strengths, weaknesses from an internal assessment, opportunities and threats from an environmental frame. And then you find strategies that allow you to seize the win by putting your strengths in the opportunities. You avoid his strengths and threats by making sure your weaknesses don't get hit by his strength. You just avoid. Number 3 is, how do I reduce my exposure by taking opportunities and mapping those to weaknesses to get better? And then number 4, how do I use my strengths to negate his strengths? So 4 different categories of strengths, right? Strategies for winning big, strategies for avoiding the enemy's threats, low-cost strategies to reduce vulnerabilities, and then using my strengths to defeat his strengths if I have to. Well, Barry he went through this thing systematically and just listed every possible thing he might do to get big wins. And what he did was systematically go through his strengths against each and every one of those opportunities, and then just listed all the things that he could do without any thought yet about about cost or effectiveness or priority or payoff. And he gets all of this stuff out of his head. Every one of those things are possibilities. Look at those. Look at the work he did. Beautiful. Then number two, what kind of things could he do? How can he ensure the threats are not able to exploit his weaknesses? What kind of insurance can he do? So he went through all of those things. How can he seize opportunities to improve his own weaknesses? All those things. How can he divert, where and how might he divert his strengths to reduce threats? So he does all those things. His next step is to go through those, now that he's got them outside of his head. This is, let me just show you the guidance that I gave him. I think this is so amazing. And I just have to share this with you. Tortoise base camp. Thank you for bearing with me on this one, by the way. I just think this is good advice for everybody to consider. And this is one of the reasons you might want to think about the coaching. This is the Euro guys, Barry, Ivan, Eric, and now Laurent. They're all in the European time zone, so they're all working together in this group of four, and we're exchanging ideas, but really they're doing the heavy lifting themselves and asking me for guidance as needed. So they're doing some of this work with the SWOT analysis, and Barry did his work. And so this is my guidance to them, and specifically my guidance to Barry. And this is something that you might want to think about as well. Barry, I would like you to share your work. I would like to share your work as I've done. He gave me some permission. And I want you to reflect on how you feel now that all that stuff is out of your head and onto paper. And then I made the observation, is it any wonder that we have confusion about which way to go and what to do next when we're taking on new ideas? And then I asked him to think about what part of you is now satisfied now that everything's on paper. And my hint is it'll be the same part that will whisper to you and say, well, there's probably even more that might be done. So that list, because that list is not all inclusive. It's a little part of us that gets paralyzed by analysis because it jumps at shadows. But I then advise them with an active part. Now that you've taken this step, you should be able to say something to that little part of you that keeps whispering about other things that might be done. And then tell it to get back into line, or get back to the workshop and work behind the scenes so that we can get on with doing the work. And then that little quiet part, the risk averse part, can continue to build the list. So I'm asking him to think about what it was like to get all of those ideas out of his head onto paper. Now we're going to go into this into this effort by going through the ABC system of priorities that I gave them. So we're going to take the best strengths and the best opportunities and give that the highest priority. Because if I can get my biggest strength and the biggest opportunity, then that's the strategies that I want to prioritize. So we're going to go through a prioritization process where we start sorting out that great big list. But the beauty of it is that he's gotten this out of his head and he's cleared up that thinking space so he can go after those hundreds of possible strategies and then start evaluating them rapidly to figure out what might be done. That's going to then help him build out his particular plan. Now he's got his trusted agents in the Eurozone small coaching group to work their way through that, and I'll be giving them weekly and monthly guidance on how to develop this. But you can see that this is the systematic, disciplined way in which they're going to go about personalizing all of these systems and ideas to make it their own. And that's better than just listening to me. It's them doing the work to internalize this stuff. You combine that with the TC 2000 bundle, and you will be able to self-coach and self-adapt for the foreseeable future, because our statistical-based approach to the markets accounts for volatility and changes in the market based on price action. And that's what gives you a long-term, robust way to deal with the market. So that's everything I want to cover. And I'll get this processed and published for you. So thanks for hanging in there, guys. Be ready for that massive down move from at the open tomorrow. We'll just handle that with hybrid frogs like we always do. in the usual way. It'll be routine trading in volatile markets. So thanks for hanging in there. Take good care. Send me your questions, and we'll keep after it. I'll be doing the daily debriefs and whatnot each night at 8 Central, at least for all this week. And then we'll just take it from there. So thank you so much for your kind attention, and we'll see you in the chat room. Take good care.